here today to talk about financing and investing in US farmlands. This is as much a conversation for farmers as it is for investors. Pepo and I are from Farmers Business Network. We'll talk a little bit more about our company, but we're here talking specifically about farmland capital, which is a financing option, again, for farmers, but also for investors to invest alongside farmers. So, Pepo.
Yeah, nice to meet you all. I'm Pepo Peschiera. I am originally from Argentina. Grew up in a farming family there, studied agronomy, finance, started my career scouting crops, then built a farming company, was renting farms and growing grain crops in Argentina. Went up to grow 15,000 acres at some point. Moved to the US about 10 years ago and been investing in farmland, first like in traditional farmland investment funds, and then about a year and a half, 2 years ago, joined forces with FBN to bring this farmland capital product to market, where we're basically co-investing on farms with farmers.
Great, and my name is Melissa Bermudez. I grew up in Massachusetts, in a pretty rural part of Massachusetts, but still doesn't compete with Iowa. I started my career in investing, in investment banking, and then moving into the buy side. And for the past about 5 years have been in the agriculture space. I started with FBN about 6 months ago to really build out the investor side of what we're doing. And so specific to investors, if you've got any questions at all about the product, you can feel free to follow up with me. There's also some materials in the back, my business card, and yeah, we'll have more information at the end. Also, feel free to ask any questions throughout this time, and we'll obviously have time at the end as well. So, stats you guys are probably all familiar with. What our product is meant to address. The increasing age of the average US landlord at 65, how much money is required to actually purchase a farm, 40% down payment in Illinois at farm prices and average prices in 2022 per acre. That was $1,356,360. A lot of money for a new farmer to be getting started. And the proportion of all US cropland that's rented to tenant operators. So those are a couple of things we think about, and again, to Pepo's point of coming here and building out this product, what this product is really meant to address in the market. But also in this context of farmland becoming an asset class and becoming increasingly attractive. And I don't know who saw the headline today, but athletes getting involved at $48,000 per acre purchase prices in Illinois farmland. So we're here talking about that in a solution and a way for investors to get access to the asset class. Amidst a world of decreasing supply of high quality land, more and more competition between investors and farmers, and then that share of owner operated farmland decreasing. So we'll talk about farmland capital, which is really meant to address all that. From the investor perspective, we've built a product that really optimizes appreciation for investors while ensuring that farmers are retaining ownership in their land. And so really building something where farmers and investors can partner with each other to retain ownership and control in rural hands. So what is farmland capital itself? For farmers, it's non-debt financing that has to be repaid in a 10-year term. The farmer can buy out the investor before then, but it's not debt, so there's no interest. And what the farmer is repaying to the investor is a new valuation of the farm. And so what that means for investors is you are co-investing in a minority value of the farmland, you're co-investing alongside the farmer, and your gain is in the appreciation of the farmland. So on the left are a few key farmer uses, certainly to buy new land, help with that 40% down payment, cash out equity in their land by bringing on a co-investor, or buy out family members, or just reinvest in your business. And what that means for the investor is you're partnering with a farmer, a very experienced operator who knows their land best and is most well-suited to be managing that. You're getting access to exclusive high-quality properties we'll talk about in a second. And you're really partnering with that farmer, sharing incentives to grow value over time. So a little bit more about how the structure works. What we did here was really design this in a way that both for farmers and for investors, we're optimizing what matters on either side. So for the farmer side, that actually means retaining all cash flows. That's that middle pie chart. The farmer is getting all cash flows during the period of the investment. But for the investor, what we're doing is optimizing the appreciation, which is historically where the majority of farmland returns come from. Normally, in kind of a more traditional real estate model, there's the appreciation plus the cash rent. We're optimizing the appreciation, about the 6% historical appreciation we see from the USDA. And so what that means is the co-investment is a minority portion of the equity value of the farm. In this case, it's about the 38%. But then at the end, because the investor is not getting any of the cash flows during that period, they're getting more of the appreciation. So that's where that 38% turns into 47% of the appreciation. And with this model, if you just take kind of the historical USDA 6% appreciation, what that turns into for the investor is an IRR of about 14%, as well as for the farmer. And Pepo's going to go into that in some more specific cases. And so FBN, Farmers Business Network, we've been around since 2014. Some of you might have heard of us. We are a company that really is just here to support farmers on all sides, on the input side, crop insurance, crop marketing, and finance. We've actually reached a valuation of almost $4 billion at this point. We've got quite a well-respected base of investors supporting us, from Fidelity to Google Ventures to BlackRock. But more importantly, also from kind of the pipeline perspective for deals that we have, we've got almost 50,000 members in our network that are farming 20% of US acres. In 2022, this past year, we had $11 billion of financing requests and closed $1 billion in our history so far. And so what that really means, especially from the investor side and the pipeline perspective, is you're getting access to a very high quality pipeline of opportunities. And also, as a result of our structure, you're getting access to much, much more of the land financing market. So that gray part there, the small part of this pie chart, is the portion of all land transactions in a given year that are sold on the open market, what the historical kind of institutional market is getting access to. But because of our structure, we're able to gain access to refinancings, which is the largest portion of this pie, as well as land in states with corporate ownership restrictions or in transfers, family transfers, wills, and trusts. So what that all comes down to is a larger, higher quality pipeline than the relative institutional market, and also allows us to be more picky and choosy. We've invested in less than 5% of the transactions that come to us, and we think creates just obviously better investment opportunities. And so just a little bit more about FBN. So we're a team overall of actually about 1,000 employees at this point, but the finance division specifically is over 100 people. We're a mix of data scientists, economists, folks who've spent their whole careers in ag lending, ag financing, appraisers, et cetera. And so all of that is behind this effort of Farmland Capital and really meant to support the efforts we're here talking about today. So with that, I'm going to pass it to Pepo to talk a little more.
Thanks. So I'm going to talk a little bit more about why farmland. Probably are very familiar with that, but we now have to feed more people with less land. If we go back to the 60s, now we're feeding the same people with half of the land. And that population is prone to continue going up, so that problem is not going away. That has resulted in appreciation of farmland. Over the last 80 years, farmland has appreciated 6% per year, in track with returns from the S&P, for instance, but less volatile. If you look at the green line there, it's a more smooth line with less volatility than the stock market has. This goes back to the 40s. So land has gone up. It's not a straight line. It has some moments where it went up more, when it corrected. It typically follows inflation, and it has actually performed better than inflation over time. And if you look on this market in particular, we're finding land values going up too, but that's also driven by farmer income going up, something that didn't happen in some of the previous times where land went up and then declined. Farmland is really uncorrelated with most asset classes, including real estate. If you look on this chart on this side, real estate has gone up dramatically over the last 10 years, and farmland has almost basically been flat in real terms. That's adjusted by inflation. So some of the investment opportunities that we have, some examples. This is a farm in Illinois where we made an investment. We invested a portion of the farm value alongside a family farmer that was buying this property from some relatives that were going to sell it in the open market. If it wasn't for this product, this farmer couldn't have retained the farm in the family. So this is a farm that is 13% above the county average in terms of soil quality. We invested on this farm at a price that was slightly below the market value, providing some buffer for the investors. And then it's a farmer that has been operating this farm for a long time, really applying long-term sustainability practices that lead to long-term sustainability of the farm. No-till, applying manure. There was an investment made in exchange for 37% of the changing value of that farm going forward. If you model the returns there, both the farmer and the investor are getting a 12% return. This is based on the historical appreciation of farmland. Of that 6%, the farmer has appreciated over the last 80 years. We closed on this investment a few months ago. There has been appreciation since that point until now. But the way we're building this product, and we're transferring these investments at cost to the investors. The investors are getting in at a value that is well below market now. These are some of the simulations of returns on this property. As Melissa was saying, it's a 10-year product, but what we found is typically farmers after 5 to 6 years, they have built enough equity on the property where they can refinance and buy this out. And we're already seeing some exits on some of the first investments we have already made. If you look at that appreciation of 5.9% historical, and if the farmer holds it for 10 years, it's an 11.7% net return for the investor. If it's a 6-year hold, it's a 14.9%. And if you look at the average appreciation of the last 20 years, you're looking more at a 13.6%. And if you look at periods with higher inflation, where land appreciated 12.5%, the returns are more like 20%. And the good thing here is like the returns of the farmer and the investor are totally aligned. In the traditional investment model, an investor is buying a farm, renting it on a 1-year lease to the farmer. The farmer doesn't know if he's going to be there another year or 2 years, so he's not incentivized to get into practices that have a longer payback period, like cover crops or no-till. Here, the farmer, it's actually thinking of holding this farm for the next generation, and the investor is participating during a short period of time. So it really helps to align those incentives. This is another farm. This is another Illinois property. It has some of the best soils in the region. It's a farm that had soybean yields of over 100 bushels. Has really good corn. Has had really good corn yields too. And another one, like if you look at the farmer's return, the investor returns, they're both aligned. And the investment amount was higher on this one relative to the farm value, so it's a higher participation in the changing value of that property. This is a pasture property in Missouri. It's a farm that is being used for dairy, producing dairy feed. Has also been applying manure to the field, so it has really high fertility. The soil has been taken really good care of. Like in most of the investments, like the investors come in at a slight buffer to the market value at the entry point. So that provides some already built-in appreciation for the investor, and then the investor is exposed to whatever happens with the market going forward. So I think a way for the investor to think about this is like it's a 10-year investment, but typically it will be shorter. It will be more like a 5-6 year duration. And it's a way to invest with farmers, not competing with farmers for land, but it's enabling farmers to become owners and take good care of those properties, investing with those farmers on that land. And then at the same time gives investors access to a wide variety of farms. Like when I was investing in farms, like following the conventional approach, I was fighting with other investors for the same 0.3% of farms that come up for sale every year. Those are the farms that come up for sale in the open market, in states where investors can invest. So everybody's chasing the same deals. With this, we have access to 10x that market, because we can work with farmers that are just refinancing a farm, farmers that are buying it from a family member that never touched the market. Actually, none of the investments we have made so far was a farm that was traded in the open market. So we're not competing with any other traditional investor. It's a way for investors to access that market that isn't out there otherwise. So well, yeah, that's it. We have a booth upstairs, right out of the conference hall. So feel free to stop there. I'm happy to answer any questions that you might have.
How do you facilitate the exit for the investor in 5 years?
Yeah, so the way this works is like, it's a 10-year agreement. The farmer can buy out anytime before those 10 years. So the way we look at this is like, we run several simulations on the farm. Every time a farmer applies, we look at his financials, his cash flows, like what is his source of income. If you think let's say on a $1 million farm, the farmer is getting $600,000 in debt, $400,000 in equity. The investors are putting $200,000, and the farmer puts $200,000 of the equity. So if you fast forward that 10 years, that debt would have gone down from $600,000 to $400,000, assuming the farm value doesn't change. So that debt goes down, the farmer repays principal, so that at some point the farmer can refinance that up to the same amount and use that to buy out the investor. The farmer is also getting the income of the property. The farmer is typically renting other farms in the area, so getting other source of income. So what we found is like typically after 5-6 years, the farmer can refinance and buy the investor out. And we also offer debt products within FEN that can help with that situation, where the farmer can refinance and buy that out. Does that answer your question?
They can't afford to refinance it, does the property sold?
So yes, like the very worst case scenario, if it gets to year 10 and the farmer hasn't been able to buy it out, then the property can be sold. At the end of the day, most likely like a portion of the property can be sold to provide the liquidity for the investor. Like farms are fractionable, so it doesn't need to, but that's a very worst case scenario, those situations. There's also a possibility to extend the agreement like a few years, but yeah, those are different options.
So is there an appraisal every time that they want to look at buying out the farm to determine how much the appreciation is?
Correct. The farmer at that point, when he raises his hand, like, hey, I want to buy this out, then we have to pick a certified appraiser that has done more than 5 appraisals in the area over the last few years, working for lenders. We get that appraisal. If either party is not happy with that appraisal, we can get a second appraisal. If the two are less than 5% apart, we average them. If they're more than 5% apart, then those 2 appraisers can pick a third appraiser, and the 2 appraisals that are close together are averaged. The idea is not to get to that point, but to have like an independent process to resolve those. And all these investments are typically in areas, are always in areas with high liquidity, so there's always like a good number of comparable sales to make sure like we're going to have a robust appraisal in the future. Yes.
Does the investor get any cash return, or is it all based on appreciation?
It's based on the appreciation of the property. So it's based on the appreciation of the entry price that the investors have. Like most of the times that entry price is below the appraised value of the property, so there is already some built-in appreciation for the investor there. But yes, there is no annual income. That's why the investors share more in the appreciation than what they are, than their equity share.
Are those negotiated with each deal? I mean, you gave us an example.
Yes.
But the amount of appreciation, is that a negotiable piece, or is it generally that amount?
It's generally an amount that is in relation to the amount that we invest in terms of what percentage of the farm value is the amount that we're investing. So the more percentage, the more share in that changing value. Mm-hmm.
Yeah, just add the kind of 2 variables that get you to the total appreciation. Can you guys hear me? Okay. The 2 variables are that discount that we invest in relative to the appraised value, and then the multiple on which the investment amount gets you to the appreciation amount. That multiple is usually quite consistent across deals. It's the discount that we depend on where we're investing.
Yep.
Good.
Some of us here have seen farmland go down.
Sorry?
Some of us have seen farmland go downside.
Yes.
Why would investors want any part of that? Would be time to buy now.
Yes. So yeah, farmland has gone down in value in the past, like in the 80s in particular. Yes. Yes. Yeah. Yes. So farmland has gone down. Like if you look in recent in the last over the last 80 years, there were two periods where farmland went down. Like one was more recently, after the peak in 2015, it went down 10-15%, and then going back to the 80s. I think what is different from now and the 80s is like now, if you look at the income that farms are producing, it's the increase in farmland values has been in line with the income they produce. Like one thing that we look at, it's the cap rates of farms. Like what is the income divided the farm value? Like what is that percentage of return the farm is producing every year? And if you go back 80 years, it's always in line with the risk-free rate, like the government treasuries. So except during some periods, like the 80s was one of those periods where like land values departed from that ratio, meaning that land values lose that connection with the income of the farm. We're not seeing that situation now. So yes, it's something that can happen, but we believe like this is the current situation is not reflective of that. And we in our website we have like some reports that have been prepared by our research team that go into the details of that. So happy to share those if you want.
I think there's also a couple of structural things with the product to help mitigate with those kinds of downturns. And one of those is in terms of when the farmer can buy out the investor. If it's within those first 7 years, to this gentleman's earlier question, whenever the farmer wants to buy out the investor, an appraisal is triggered essentially. If in those first 7 years the value is below the original appraised value, the farmer has to buy out the investor at the initial value. And again, because you're investing at a discount, there's already that potential for increase. And the second piece is that this, we can definitely go into more of how this is actually structured. In order for the investor to get more of the appreciation, it's technically structured as an option. And that means that you're investing a prepaid amount, which is the co-investment. And then at the end is the total value of your option that you need to pay. So you're not actually investing the full amount up front, which again mitigates the downside should the value go down.
Yeah, that's a good point. Like with what we found is like if the farmer is selling the farm in the open market, both the farmer and the investor are aligned. They're both trying to get the best value for the farm. If the farmer is trying to buy out the investor, the farmer might be waiting for a dip in the market to try to buy out the investor. So that's why there is a floor during those first 7 years. Like if the farmer is looking to buy that, the way for the investor to be protected is having that floor where like worst case scenario, the investor gets the return back.
It's completely correct. Like you do have to believe in farmland appreciating over the 10-year period. Like that is the return. So certainly, yeah, your own opinion matters on that front.
How's the discount?
It depends on a variety of things. Like in some situations, for instance, some of the properties here, it's a property that is in an area that has some development potential, and part of that value was driven by that. And when we're underwriting these, like the appreciations that we look at are based on the appreciation of farmland, not necessarily like land that has residential development potential. So we're taking that development value from the property in that example. In some other, like there are different circumstances, but I think that's a good example. In some other cases, where we believe like some comps that were not that relevant were used in the appraisal. So there, in some areas that there's more liquidity or less liquidity, we take like a larger safety margin in case there's less liquidity, less comparable sales in an area, for example.
Corn or soybean prices go down
If the farmer gets in trouble with the loan, you mean?
Yeah, so would the capital call be issued by the investor or?
For instance, let's say that the farmer gets in trouble and he cannot pay the loan on the property. So the agreement allows the investors to pay those interests to keep the loan current and at the same time start a sale process, an orderly sale process of the farm. So the farm doesn't get in foreclosure and the farm is not auctioned like in a foreclosure. So there's like a proper process to sell the property. In those situations, like there are two ways to do that. Like the investors can get a capital call, so they contribute to make those loan payments, keep the farm current, get that back when the farm is sold, in addition to their pro rata portion of the farm, or a loan can be obtained to cover those interests and then keep the loan current and then sell the farm.
In the interim, does the investor get a K-1 or is there phantom income?
Gets a K-1. There's, yeah.
Minority owner in the land.
Yes.
Does it generate taxable income in that period?
No, not during. That's a question for a CPA. But my understanding without being a CPA is that no, it's like a capital gains at the end of the term.
Yeah, investors get a K-1 during the period, and there's also annual financial statements, but because there's no income, it's really, we're just updating you on the farm value, essentially. And then at the end, it's because of a long-term hold. It's usually seen as long-term capital gains taxes, but yeah, it's a question for a CPA.
Did I understand that correctly? The financing that you're looking at is the investor is investing in the down payment on the farm in a traditional bank, or a traditional institution is loaning the money?
Yeah.
As he made the comment, you could end up in default if the investment is 100% of the farm value, there's no default.
Correct. So,
Different financing.
yeah, there are different finances. In that $1 million example, the $500,000-$600,000 of debt, that can be any lender. And then the investors are participating on the equity portion with the farmer. It's up to 49% of the equity. Yes, yeah, the idea is that the farmer is always the majority owner of the property. It's his farm, and the investors can participate, kind of always a minority investor. And like the agreement provides like several covenants that protect the investor in terms of like the farmer has to, if the farmer stops paying the mortgage, then the investors can jump in and sell the farm. If the farmer stops paying the property taxes, anything that puts the farm value at risk allows the investors to step in and stop that. If the farmer is taking good care of the farm, then it's the farmer's decision when to sell.
Yeah, to be completely clear about the capital structure of the farm, certainly we can come into a farm where there's no debt, but what we're doing is accessing the equity part of the capital structure of a farm. So in a new farmland purchase, it often makes sense for a farmer to use debt, and they're usually able to use up to 60% of the value of debt. We're talking about that other 40% of the debt, so then there kind of be these three tranches of capital. Yeah.
The average debt level so far has been around 50% of the farmers that we're working with. Between 45 and 50.
How many of these transactions have you guys done?
We've done, I think, 15, 20. No? Yes. Yes.
How do you guys get paid?
And that's like, in this case, it's like the farmer is refinancing the farm with a new loan, and he's using the proceeds of that loan to pay the co-investment out.
Do you guys collect the transaction fee or anything?
Yeah, we have some management fees to basically to take care of these, like to oversee like the investment, and there is a success fee too. But yeah, basically the proceeds in these exit situations that we have had so far have come from a refinance of the property.
Yeah, in terms of the actual fees, as an investment product, we have a management fee, an annual management fee of 1.25%, which compares to usually around 2% on a lot of kind of other institutional investment products. Awesome. Well, like I mentioned at the start, we've got materials back there. We'll be here. We still have time. So we'll be here for questions if you want to come up to us or the booth upstairs. But thank you all for coming. Really appreciate it.
Thank you.